Intel has been hammered. Just year to date, this stock is down 40%. We can see it at a new 52-week low, and when we took up the analyst ratings, we have one buy rating and a double hold for a company that also pays a forward yield of 1.66%. Now, is this a golden opportunity to buy a company that has been battered for long-term growth in the portfolio? We're going to do a deep dive today. We're also going to take a look at what insiders have been doing. We do notice now an insider buy of 250,000 that we will discuss. We'll also look at the institutions, their movement quarter on quarter. And one thing that we do want to cover today is, even though they have had a recent dividend cut, why is their dividend safety sitting at borderline safe right now? Are there any worries? We'll also look at the underlying metrics, free cash flow, their debt levels, as we usually do. And importantly, we'll remind ourselves of the growth of this company, how their top line revenue as well as their bottom line net income has been over the more recent period. And also, with the updated numbers from their latest quarterly report, look at the health of this company, total cash versus their total debt. And for those that missed their latest earnings, we will pull through one or two slides just to remind you of what the forward guidance as well as their performance in Q1 has been. Also, now we are going to take a look at the revised valuation, running it through the valuation model, getting to our intrinsic value as well as our acceptable buy, considering our margin of safety, and also see what Wall Street are forecasting in terms of upside over the next 12 months. So as a quick reminder, in terms of their historical performance, not the greatest. Year to date, they are down nearly 40%. Over the last 12 months, well, they've barely moved, plus 0.7%. And if you've been a long-term shareholder, well, you would have been on a bit of a roller coaster, up around 7%. Yes, the dividend yield was slightly higher before, so if you reinvested it, you would have a little bit of a better performance, but not the greatest over the last 10 years. And the more recent highs, April 2021, we're talking around 3 years ago, at $68. The share price now is more than half that. So let's find out if we have a very golden opportunity. Now, the first thing that we do want to briefly discuss is some insider movement. 0.04% of insider ownership, with one instant over the last 12 months of buys of around $1 million. Although we can see two sells as well of around 1.57 in total. Now, the more recent quarter that we do want to discuss due to the relevance, as we can see here, 250,000 worth of buys in quarter two. In quarter one, we see another 250,000 worth of buys, and you pretty much have to go to around quarter two of 2023 before you really see any sales. Now, in terms of who these individuals are, what prices have they been buying Intel stock at? We can in fact see it is the CEO himself, as we can see on the 1st of May, as well as the end of April, that he did buy over 8,000 shares, pretty much around the current trading price. So he looks to be very bullish on this company, as we can see another tranche of shares bought as well, although this was at a much higher price. So typically we would say this is a bullish signal. You know, insiders, realistically, they only buy because they do believe the share price will go up. They also are privy to information that we may not hold. So again, whether or not you want to factor this in, the information is there. And as we can see, if you do want to see a sell, you do have to go back to around the 21st of August 23. But again, whether or not you want to include that, it does seem to be a little bit outdated. Now, when we take a look at institutional ownership, well, 64.53%, we do notice $8 billion worth of sales by the institutions over the last 12 months. A lot more buying during the same period, as we can see, 21.18 to be exact. And in the more recent quarter, we do know a marginal amount more of buys than sells. And if you go back over the last 4 quarters, we see a very similar trend. So overall, institutions have been adding shares of Intel to their portfolio, and in terms of insider movement, we also note very same that they have been buying in the more recent quarter. So whether or not you want to include it, always do your own due diligence. Never copy what insiders or institutions do, but the information is there so you can use it. We then take a look at their top line growth. Now, this is just something we really want to emphasize with a company at the size of Intel. 56 billion in 2014 was their top line. When we look in December 2023, 54 billion. So over the longer term, and it is better shown on a graphical basis, their top line has barely moved. It is very inconsistent, as we do see it increase and then decrease for quite a number of years. So just something we do want to emphasize with a company like Intel, where their top line isn't consistently growing year on year, something that we do typically like to see for companies we want to invest in. In terms of the bottom line, well, actually the opposite of what we want to see. 11.7 billion in 2014, 1.7 billion in their latest annual report, and we can see the trend has actually been a bit decreasing. You can see 2014 to 2017 a decreasing trend. It did increase to 2018, but again a decreasing trend has followed. So there are some red flag indicators with Intel that we do want you to be aware of and consider whether or not this is a company for you, or maybe you are a shareholder and maybe this is one to consider whether or not it is worth adding more, holding your position, or maybe selling. We then move on to essentially the balance sheet, their total cash versus their total debt. 14.4 billion of cash short-term investments in 2014. We actually note it has increased over the more recent quarter, 21.3 billion, and as we can see, like pretty much the rest of these numbers, it is very inconsistent, although it has increased from 2014. In isolation, as always, this number doesn't really give us anything, so we do take a quick comparison numerically directionally to their total debt, which we actually see a consistent trend. Unfortunately, not the greatest metric, their total debt. It has been increasing over the longer term, going from 13.7 billion, as we can see, to 52.5 billion, something that we will talk about when we cover their dividend safety, which does look to be borderline safe. You never really want to be looking at companies that are increasing their total debt at such a rapid rate. We then move on to their earnings per share. How have they consistently performed against analyst targets? Well, actually some good news. Over the last 4 quarters, they have in fact beaten analyst targets, 100% track record. However, the negative news, the next 3 quarters, they are anticipating very poor growth, or in fact negative growth to their earnings per share on a year-on-year comparison. You have to go all the way to quarter 1 of 2025, so the next 4th quarter, to see any growth, but it is very large growth as we can see. And in terms of their earnings per share targets, 109 for 2024, 198 for 2025, and this would give them a forward P of 15.25 if they do hit that 2025 earnings estimate. Again, let me know whether or not this information is useful, but it is something that we just like to show, more to see their track record against analysts as well as their future projections. Now, the next one is a quick valuation grade. Now, they do get a C+. One of the things that we look at is essentially their P on a non-GAAP basis forward looking, 27.62, so it is at a premium to the market or the sector, 23.32, so you are paying an 18.41% premium to others in the sector, but we'll come and look and see whether or not it is worth it for this company. Other metrics as well, if you do want to take a look, nice to note on a price to cash flow, 11.49, so that is much lower than the sector of 23.08. Same can be said on a trailing 12-month basis as well. Whether or not any of these are ones that you like to include, the information again is available. We then look at their growth grade. Now they get a D-, not something we really want to see. In terms of revenue growth, well, it's negative 2% with the sector at 3%. Forward looking, pretty much flat with the sector at mid-single digits at 6.5%. And what we want to draw your attention to, which as we can see is pretty high, in terms of the earnings per share, Intel anticipate 48% increase to the EPS year on year over the next 3 to 5 years, significantly better than the sector of 13.75. Something to incorporate, and one thing we would say, as we can see historically, they are pretty strong in terms of hitting those targets. When we then look at their profitability grade, they get an A+. Few things that we want to pull out. Their gross profit margin, however, is lower than the sector, 41 versus 49. When we look at their bottom line, though, it is better, 7.36 versus 2.72. And we can also see their cash from operations, significant amount, 12 billion versus the sector at 88.36. In terms of a quick roundup then for this part of the analysis, 1 buy rating from Seeking Alpha, a double hold, C+ on the valuation, D- on the growth, and A+ on the profitability. Now, yes, they haven't performed great, but let's still do a quick comparison against others in the semiconductor industry. We have Analog Devices, Micron Technology, TXN, a very popular one. All of these we have covered on the channel. Now, it is just to see how it has performed against others. Now, remember, this includes dividends reinvested, and what we can see, over the large part, their competitors have performed fairly strongly. We're seeing some nice double-digit growth. Intel, though, only 2%, and that is the worst performing. No surprises there. Over the last 5 years, what we do note, again, the worst performing, remember this is including reinvesting those dividends. Over the last 10 years, For Intel, what we can see here is that over the longer term, they are up around 40.7%. Again, not only the worst performing, but essentially a very poor return on your investment over that period. As always, just because they've been terrible over the last 10 years, past performance is not an indicator of the future performance. Now, before we take a look at their dividend safety, just to let you know, we've released our latest free weekly article, Best Recession-Proof Stocks. If you want access to all of these, all completely free, do click on that pinned comment below. You can start reading straight away. If you want to know the websites we use on the channel, do click on this article to read. Or if you want to know 20 undervalued dividend stocks to consider for your own portfolio, again, go ahead, it is all completely free. Now, in terms of their earnings, this was released around 4 weeks ago, so this is just a quick update. First one to note, for the quarter, their revenue was up around 9% year on year. As we can see, the outlook was around flat, so that is nice to note. 45 in terms of their gross margin, up 6.7 percentage points year on year. Remember, on this channel as well, we do want to see increases to revenue as well as the essential margin, so that is a positive sign. And we also note their earnings per share on a non-GAAP basis was also up year on year. So good to know. The only thing I do want to mention here is that forward looking, remember, in terms of their earnings per share, it is anticipated to be down from the previous year. We then take a look at how they've performed both revenue and margin, which are very important for me. I do ideally want to see these increase over the longer term. What we can see is their essential revenue has increased pretty much up to quarter 4 of 2023 before reducing. What you could potentially argue is the cyclicality, or in fact the seasonality, hence why when we do compare Q1 24 to Q1 23, we see growth not just in their top line revenue, but also in their margin from 38 to 45. So one thing we will be looking at is their quarter 2, whether or not it is an increase, not only from the previous quarter, but also from essentially the same quarter last year. Otherwise, if you just look at it from the previous quarter, they are down on both a revenue basis as well as a gross margin. Finally then, before we move on, we just want to point out that they are looking for their next quarter, which they will be reporting not too far along in the future. Their revenue, they're anticipating this to be flat year on year. Their margin, however, very nice to note, up 3.7 percentage points, and their earnings per share down marginally around 3 cents. So we will cover it when they release it, but always good as a reminder. Now, in terms of dividend safety, a borderline safe score of 50, a little bit worry, especially since they did just cut the dividend not too long ago. Market cap 129 billion. They are a mega cap company, and we can see, in fact, they were downgraded to this on May. So this is a very recent downgrade. What this effectively means is that there is a moderate risk of a dividend cut over a full economic cycle. So before it was sitting at 60, now it's at 50. Key metrics then from the last recession, they did maintain the dividend during the 07-09 crash. They're below a recession sales, negative 18 versus the S&P's negative 12, and they returned not too far off, negative 49 with the S&P coming in at negative 55. No surprises, they haven't increased the dividend in some time, with essentially a cut making a negative 9% decrease to the dividend over the last 5 years. But over the last 20 years, if you have been a shareholder, on average, it has gone up 12%. And we can see here clearly that dividend cut in 2022. Now, in terms of the streaks, no surprises here, 0, both in terms of consecutive and without a reduction. And when we take a look now at dividend yield theory, it does state a company is undervalued when the current yield sits above the 5-year average. So you could argue overvaluation on this method, but we would say for today's episode, it is a bit irrelevant given they have had a dividend cut. So we would need to wait a few more years before this does come relevant. And in terms of the forward PE, well, 24, it is higher than the 5-year average of 13.5. And we do in fact note is pretty much bang on the same as the sector PE in information technology. So in terms of the free cash flow payout, now one of the reasons why we focus on free cash flow over the earnings, it is susceptible to manipulation by management through accounting. We can also spot dividend cuts by looking at the free cash flow. Below 50%, we want to be specific for the industry of the semiconductors. What this effectively shows us is negative over the last 2 years, and expected in 2024 that they have negative free cash flow. Not a great sign, but let's keep moving on. And as we just said there, we can clearly see here been negative over the last 2 years and anticipated in 2024. Free cash flow, what we ideally want to see with this is growth over the longer term, which we unfortunately don't see as it has gone from a positive to a negative, and we can look into the future. They are anticipating this to continue moving forward. In terms of sales growth then, not the greatest, 3 to 7%. We did look at the numbers earlier on. We can see the percentage movements now. Massive decrease, in fact, negative 20%, negative 14% on a trailing 12-month basis, and negative 2%. They don't anticipate much growth for the full year of 2024. Numerically then, this is what we just saw not too long ago. One thing we would say is they have returned excess cash to investor pockets through those share buybacks, but we do want to say from 2021, they've actually done the opposite. They have diluted your position. As we can see, it has increased over the last few years. Something just to bear in mind, maybe factor it into your margin of safety. Now, in terms of ROIC, very important metric, return on invested capital, 10% or more, or 12 if you want to be, again, industry specific, giving us faith management can effectively allocate their capital, and we have known they have been able to do that from 2014 to 2021. Since then, though, the last 2 years looking very low. Again, another red flag indicator that I would say that you should consider when you do look at your own due diligence. Operating margin, quite easy there. Nothing really positive to say over the more recent period. It has dropped massively in 2022 as well as essentially 23 where it is nil. So it could be a case where in 2024 they don't turn a profit if their margins are flat, or if they do turn negative, something just to consider. Free cash flow margin, no surprises in the more recent period as we did see negative free cash flow, but before then they were looking very strong. So again, do consider whether or not this could be a value play, or maybe even with the low dividend, this isn't one that you are looking to consider. Net debt to EBITDA, then the earnings before interest, tax, depreciation, amortization. It does help us with the dividend safety and balance sheet as it directly correlates between them. Below 1.5, number of years essentially to pay off all of their debt net of cash on hand. What we can see 2, so it is above the 1.5. Yes, it is anticipated to come down a little bit in 2024, but this is very high, so we would say just be aware of this, and again, factor that into your valuation as well as when you are looking at your own investment thesis. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So the first model we're looking at is Graham's valuation. We have the stock ticker symbol, the expected earnings per share for 2024, the long-term growth rate looking very high, corporate bond triple yield, and it does get an intrinsic value showing over 20% undervaluation as we can see here, but just bear in mind we're not looking at any one of these models in isolation. We then move on to the multiples valuation model. Companies in a similar sector and size, their PE, average P multiplied by the EPS of Intel to get a marginal increase from the current market value. Again, another undervaluation signal. We then move on to the dividend discount model, where we do see the growth rate over the longer term, and we do note that dividend cut that they had not too long ago, giving them a negative 9% increase, or in fact decrease over the period. In terms of growth rate, forward looking, we do hope they can increase it a lot better, around 6%, given the fact they have dropped that dividend very low to around 1.6%. In terms of this, well, we do still see overvaluation of nearly 10%, as we can see an intrinsic value just under $28. We then move on to the DCF model with the free cash flow year on year, average growth rate. Forward looking, we have gone for around 5%, fairly conservative in our opinion, especially based on management and analyst targets. Discount rate, we get the present value of future free cash flow and terminal value. As to go with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as we can see, a nice undervaluation signal of around 30% upside purely on this model. So we get to the intrinsic value in today's episode. It is the average of these four models, coming to around $33.81. Don't forget you can click on the pinned comment below, grab a copy of this model, get your own intrinsic value, whether it's for Intel, others in your portfolio, or those on your watch list. So we start off with a 10% margin of safety, and we only execute on that if we believe it meets 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. And we can see for today for Intel, if you believe that it is pretty much trading around a 10% MOS level. In terms of moving forwards, well, if you believe you want it around a 15%, it would have to wait to around 28.74. At 20% around 27, and we can see 25% $25. Today's episode though just around a 10% margin of safety. But as always, do let us know your thoughts in the comments below. Maybe this is one you are satisfied with a 15 to 10% margin of safety, or maybe you want a significantly larger MOS level. On the flip side though, Wall Street do consider this to have upside of 26%. Their price target is $38. They do believe it to be higher than our intrinsic value. So whereas we may not consider this a very strong buy, we do see that Wall Street do consider this one for the portfolio. As always, let us know your thoughts in the comments below. Is this one you're looking to add, maybe on the watch list, or maybe this just isn't one you are looking to consider at all? Let us know your reasons why below. If you've enjoyed today's episode, smash that like button, hit that subscribe and bell button. As always, we'll see you all on the next one.